For generations, the definition of wealth was something you could touch, something solid, something real. Ask your grandparents what it meant to be secure, and they likely wouldn't talk about stocks, bonds, or digital currencies. They'd talk about two things: the land under their feet and the gold in their safe. Real estate, the dream of a home, a piece of the earth to call your own. And gold, the timeless store of value, a safe haven in a world of uncertainty. These weren't just investments, they were legacies. And today, in our hyper-connected, fast-paced world, these ancient assets are making a roaring comeback. Gold is hitting all-time highs as central banks around the globe stockpile it, a clear signal of confidence in a turbulent world. At the same time, the real estate market, after years of stagnation, is booming once again, with high-end properties leading the charge. This leaves the modern investor with a timeless question. In the 21st century, where should you put your hard-earned money? Which of these titans of investment truly deserves a core place in your portfolio? Today, we settle the debate. We're putting gold and real estate into the ring for the ultimate 5-round battle. We'll analyze them across 5 critical factors: liquidity, passive income, volatility, cost of entry, and the hidden dangers you can't afford to ignore. By the end of this video, you will have the clarity you need to build a smarter, more resilient financial future. Let the battle begin. Round 1. The liquidity test. In the world of investing, liquidity is king. It's the answer to a simple, crucial question. How fast can you turn your asset into cash in an emergency without losing significant value? First, in the red corner, we have real estate, the illiquid giant. Owning a property feels secure, but that security comes at the cost of flexibility. When you need cash, you can't just sell a bedroom or a balcony. The process of selling a home is notoriously slow and cumbersome. It involves finding a real estate agent, listing the property, waiting for potential buyers, enduring inspections, negotiating offers, and navigating a mountain of legal paperwork. This entire process can easily take months, sometimes even years, especially in a slow market. And here's the kicker. The price you see on paper is rarely the cash you get in your pocket. Experts note that the final sale price is often 5 to 10% lower than the perceived market value. Once you factor in negotiations, agent commissions, and closing costs. For a sudden financial crisis, a medical emergency, or an unexpected job loss, real estate is simply not a viable, immediate solution. Now, in the blue corner, gold, the liquid safe haven. Gold's biggest strength is its universal acceptance and ease of conversion, especially in its modern, digital forms. If you own a gold ETF or a gold-backed mutual fund, you can sell your holdings with a few clicks on any trading day, and the cash will be in your account within a couple of days. It is as liquid as any stock. Even physical gold offers strong liquidity, though with a few caveats. A gold coin or bar can be sold quickly at thousands of dealers worldwide. The challenges arise with jewelry. Many jewelers may not have a buyback policy, and if they do, they will almost certainly deduct the making charges, which can be a significant portion of the original price. Furthermore, banks in many countries, including India, sell gold coins and bars, but are not permitted to buy them back. But despite these minor hurdles with physical forms, the verdict is clear. When it comes to speed and ease of converting your investment into cash, gold wins this round by a technical knockout. Its digital forms offer near-instant liquidity, making it a far superior asset for emergency funds and financial flexibility. Round 2. The passive income stream. A great investment doesn't just sit there. It works for you, generating a steady stream of income. Does your asset pay your bills while you sleep? Let's start with gold. In this arena, gold is what you might call a dead asset. It is beautiful, valuable, and a great store of wealth, but it generates zero passive income. It doesn't pay dividends, it doesn't yield interest. The only way to make money from gold is through price appreciation, buying it low and selling it high. While it sits in your portfolio, it contributes nothing to your monthly cash flow. Its entire value proposition is based on the hope that someone else will pay more for it in the future. Now, let's turn to real estate, the income generator. This is where property truly shines. Owning a rental property offers the potential for a consistent monthly income stream that can help cover your mortgage, pay bills, and even fund your lifestyle. This rental income provides a tangible return on your investment, separate from any long-term price appreciation. However, passive income from real estate is often anything but passive. It requires active management. You have to find and vet tenants, deal with repairs and maintenance, handle potential vacancies, and navigate landlord-tenant laws. While property managers can handle this for you, their fees will eat into your profits. Furthermore, rental yields, the annual rent as a percentage of the property's value, are often modest. In many major cities around the world, yields can hover between 2 to 4%, which might not even cover all your expenses after factoring in property taxes, insurance, and maintenance. But even with these challenges, the potential for income exists, which is more than can be said for gold. In the battle for passive income, the winner is clear. Real estate lands a decisive blow. For investors seeking a regular cash flow to supplement their earnings or fund their retirement, property is the undisputed champion of this round. Round 3. The volatility roller coaster. Every investment has its ups and downs. The question is, which of these two assets offers a wilder, more unpredictable ride? Let's look at real estate first. Its performance is cyclical and intensely local. The value of your property is tied directly to the health of your city or neighborhood's economy, local job growth, infrastructure development, and interest rate trends. A new subway line can send prices soaring, while a major company leaving town can cause them to plummet. This localization means real estate can be a tale of two cities, booming in one metro area while stagnating in another just a few hundred miles away. And stagnation can last for a very, very long time. It's not uncommon for property markets to go flat for 5 to 10 years. Now, for gold. Gold's volatility is driven by global macroeconomic forces. It's a global barometer of fear and uncertainty. Its price swings wildly based on the strength of the U.S. dollar, changes in global interest rates, geopolitical tensions, and fears of inflation. When a war breaks out or a major economy falters, investors flock to gold, sending its price skyward. It's considered a direct hedge against these global shocks. But this also means gold can be incredibly fickle. Just like real estate, it has endured long, painful stretches of dead returns. For instance, between 2013 and 2018, gold prices were largely stagnant, offering returns lower than even simple savings instruments in some countries. It's an asset that demands immense patience. So, who is more volatile? This round is a draw. Both assets are volatile, but their personalities are completely different. Real estate's volatility is local and slow-moving. Gold's volatility is global and fast-reacting. Choosing between them isn't about avoiding volatility. It's about choosing which kind of volatility you are more comfortable with. Round 4. The cost of entry. How much capital do you need just to get in the game? This is often the biggest hurdle for new investors. Real estate enters this round with a clear disadvantage. It has an incredibly high barrier to entry. Buying a property requires a massive initial investment. You need a significant down payment, which is often 10 to 20% of the property's value. But the costs don't stop there. You have to pay for inspections, legal fees, title insurance, and in many places, hefty transaction taxes like stamp duty. For most people, getting into the real estate market means saving for years and taking on hundreds of thousands of dollars in debt. The entry ticket is prohibitively expensive for many. And then there's gold. In its modern form, gold is perhaps the most accessible investment on the planet. You don't need a fortune to start. Through digital gold platforms, gold ETFs, or mutual funds, you can begin investing with as little as $10 or $20. This democratizes access to a historically elite asset. It allows anyone, regardless of their income level, to start building a position and benefit from its potential growth. It is the definition of a low barrier to entry. This is the most one-sided round of the match. Gold wins by a landslide. For accessibility and ease of getting started, it is simply in a different league. It empowers the small, everyday investor in a way that real estate cannot. Round 5. The hidden dangers. On the surface, both investments seem straightforward, but beneath the surface lie unique and significant risks that can trip up even the most careful investor. Let's unearth the hidden dangers of real estate. The biggest risk is not a market crash, but the potential for legal and regulatory nightmares. Issues with property titles, fraudulent sellers, and delays in construction from developers can turn your dream investment into a costly legal battle that lasts for years. Then, there are the ongoing costs. Property is not a buy-and-forget asset. It demands constant upkeep. There are recurring property taxes, insurance premiums, and unexpected, often expensive, maintenance costs. A leaky roof, a broken furnace, a pest infestation. These can quickly erode your returns and drain your savings. Now for the hidden risks of gold. For physical gold, the primary dangers are storage and security. Storing a significant amount of gold at home makes you a target for theft. Using a bank's safe deposit box is a safer option, but it comes with annual fees. And crucially, the contents are not typically insured by the bank against theft or disaster. Beyond security, there's the risk of purity with jewelry and the low resale value due to the deduction of making charges we mentioned earlier. Digital gold mitigates these physical risks, but it carries its own counterparty risk depending on the provider. In this final round, there is no clear winner. It's another draw. Both assets come with their own set of serious, non-market risks. Real estate is plagued by high maintenance and legal complexities. Gold is haunted by the challenges of security and physical ownership. Success in either requires rigorous due diligence. The bell has rung for the final time. Let's go to the scorecard. Gold took the win on liquidity and cost of entry. Real estate was the champion of passive income. And on volatility and hidden risks, it was a dead heat. So, who is the ultimate winner? The truth is, there isn't one. The best investment is not a universal title. It's a deeply personal choice that depends entirely on your financial goals, your time horizon, and your risk tolerance. If you are a young investor who needs flexibility, has limited capital, and wants a hedge against global uncertainty, gold is an excellent starting point. If you are an investor with significant capital, a long-term horizon, and a primary goal of generating regular cash flow, real estate is a powerful tool for wealth creation. But the smartest strategy isn't about choosing one over the other. It's about understanding their unique strengths and combining them in a diversified portfolio. For most people, a sensible and balanced approach looks like this. First, focus on owning your primary residence. It's more than just an investment. It's the foundation of your life. Beyond that, consider allocating a small portion of your investment portfolio, say 5 to 10% to gold, preferably in a low-cost digital form like an ETF. This gives you the best of both worlds, the stability and income potential of property, and the liquidity and diversification benefits of gold. Ultimately, building wealth isn't about finding a single magic bullet. It's about building a robust and balanced arsenal. What's your strategy? Are you team gold or team real estate? Let us know in the comments below. And if you found this guide helpful, subscribe for more deep dives into smart investing.